you should be investing in the stock market steadily. No breaks, no quit, still there. Hey guys, on this video, I just want to talk about the state of the U.S. economy, especially given the fact that just a few days ago, the Federal Reserve decided not to raise the federal funds rate again. They decided to put a pause on the federal funds rate. So I just want to have a conversation about some really important things that we need to be considering, especially average, regular U.S. consumers who may be investors, what we need to be thinking about and doing in the process of all the things that are happening in terms of the U.S. economy, guys. As we know, guys, the Federal Reserve had raised interest rate, federal funds rates, 10 straight times, right? They had raised the federal funds rate. That's going back 15 months ago, back to maybe March of last year. They just kept raising and raising and raising the federal funds rate. Now, the federal funds rate is the rate that commercial banks charge one another for overnight lending. And when that increases or decreases, it sort of has a ripple effect on the rest of the economy because it makes borrowing money more expensive. For example, if you have a 2.5% mortgage rate, all of a sudden now mortgage rates are in the 6s and close to 7%. So money got more expensive. Now, the mortgage rates in particular are not directly affected by the federal funds rate, but there's a trickle-down effect. And usually, not always, but usually, when the federal funds rate increases, that affects treasury bonds and ultimately that affects mortgage rates. But the point is, guys, is that money is now more expensive to borrow. About a year and a half ago, guys, the federal funds rate was near 0%. Now the federal funds rate is between 5 and 5.25%. And the Fed decided, hey, we're not going to raise that just yet. We're going to look at some other factors coming up in the economy before we touch it again. Now, the Fed Chair Jerome Powell, he also pointed to the fact that they do expect to raise interest rates at least 2 more times by the end of the year. So they're giving us that warning up front. We are going to make money more expensive to borrow a little later in the year, which is also around the time that they are predicting that we'll be falling into a recession, right? 2 straight quarters of a down GDP where the economy is not growing. That's the textbook version of a recession. So while the Fed has paused interest rate hikes, and I think they paused them for a number of reasons, right? Because of the fact that the CPI numbers are down to 4%, less than half of where it was last year, around 9%. But the core PCE, which is the main measure that the Federal Reserve uses when they're looking at inflation, and the core PCE is a broader look at the overall inflation numbers. It takes out the 2 volatile things that they say are really up and down, which is energy prices and food prices. So the core PCE gets rid of those 2 things and gives you a broader look. Well, the core PCE, guys, eked up just a tiny bit, up to 5.3%. So the Fed is saying core PCE is still very, very sticky. In other words, inflation is rising right now at 5.3%. Not the 9% or the 8-9% we were at, but it's still increasing by more than the 2% inflation that the Fed really wants to see. So inflation is still there, it's still happening, it's still not going anywhere, partially because we have one of the strongest labor economies that we've had in the last 50 some odd years, guys. Unemployment has been hovering around the 3.4, 3.6, 3.7% mark for quite a while now. And when that's happening and most people are able to find work and have a job, then people have a tendency to continue to spend. And when people continue to spend, prices continue to increase at a faster pace, which is why we have this core PCE that's stuck right around the 4.5 to 5% range. So the Fed took note of all that, said we're going to pause it. Now, as I mentioned, the Fed said that we're going to have some type of recession later this year. Now, what they're predicting is the GDP is not going to be increasing. Now, in Q4 of last year, the GDP was 2.6%. Q1 of this year, the GDP was down to 1.1%. So the GDP is continuing to it's still growing, right? But it's growing at a slower pace. And so what they're predicting, as I mentioned, guys, is they're predicting that at some point from 2.6% to 1.1%, the GDP ultimately in Q3 and Q4, or maybe even Q1 of next year, is not going to show growth at all. Now, of course, they don't know that for sure. That's just a prediction, and the Fed has been wrong before. But they kind of control the money and the money supply. So if they control the money and the money supply, and they're predicting a recession and they're letting everybody know that there's going to be a recession 6 months ahead of time, then I think we probably need to be preparing for a recession, which could mean higher unemployment. It could also mean a hit to the stock market as well. Now, speaking of the stock market, let's kind of talk about that real briefly. Now, when the Fed actually decided not to raise rates, everybody was thinking, okay, we're going to have a rally in the stock market. Because when the Fed does not raise the rates, typically the stock market goes up. But if the Fed tends to raise the rates, the stock market responds unfavorably and goes down a little bit. But although the Fed decided to pause rate hikes last week, the stock market didn't really have that rebound and that rally like a lot of us thought it would. Now, what does that mean for us, guys? It means we have to, if we're investing in the market, in the stock market, whether it's ETFs or whether it's index funds or mutual funds or individual stocks, what have you, we need to keep investing in the stock market, guys. Continue to do that. Now, for us guys, us regular investors, not us big time, you know, we don't have 30 and 40 and 50 million dollars and all that. We're not a mega investor, right? For us casual, regular consumer investors, we need to be at the point where we're always in the stock market, no matter what. Up, down, doesn't matter. We're just kind of dollar cost averaging at all times. And I say that, guys, because of this. I read a study recently, guys, that said that 42% of the S&P 500's best days in the last 20 years occurred during a bear market, occurred when the market was down. That's the best days of the S&P in the last 20 years, 42%. The study also said that another 34% of the S&P 500's best days were during the first 2 months after a bull market, before we even knew the previous bear market had even ended. So in other words, instead of trying to time the market, jump in, jump out, move your money around, stay the course. Stay where you're at. Just keep investing. When it's a down market, a bear market, you're buying stocks at a discount. You're buying stocks undervalued. And that's what you want to do to make real money in the stock market. You want to buy stocks that are undervalued, because when they bounce back, you got a bunch more shares, right? Now, guys, listen. The whole purpose of the stock market is to make money. The whole purpose of buying businesses and investing in businesses is to make money. Now, I didn't invent that system, guys. That system is out there. It's called the stock market, and there's many ways to get involved with it. But guess what? They ain't going to let the stock market crash for the next 5 years in a row, and all of a sudden you have stocks today that are worth 100,000, then 10 years from now they're worth 30,000. That ain't going to happen, guys, no time soon in my lifetime, and probably not your lifetime. So you want to be in the market, because ultimately the market is going to bounce back. The market is going to have its bad days, it's going to have its good days. But the money is really made during the bad days. The money for investors is made, most of the money is made when the stocks are undervalued, and it feels like there should be some panic and some fear. But guess what, guys? That's precisely the time when you want to be in the market, when you want to be investing in the market, right? So guys, be investing in the market, be dollar cost averaging, making sure that you are investing in the stock market before the bear market, before things go down, while things are down, and then while things are rebounding and recovering and coming back up. The whole time, you should be investing in the stock market steadily. No breaks, no quit, still there. The other thing you want to do, guys, is you want to pay attention to the labor market. Stay up on what's going on with that, because unemployment went from 3.4% the previous month to last month 3.7%. So unemployment may end up creeping up just a little bit here soon, guys. So stay tuned for that too. Now, guys, listen, I am not a stock market expert. I'm not an expert in any of this. I'm not an economist or any of that type of stuff, guys. I'm just giving you my opinion, okay, in what I'm observing as an investor in the stock market. And I've been investing in the stock market through my job's retirement plan, but understanding exactly what my job is investing the money into for many, many years, guys. And these are just my observations, things that I notice, and the conversations I have with people who tell me all the time, well, I pulled money from here and I shifted money over there. Well, I saw something on TV and the market looked like it was doing this, so I'd grab my money. You don't have to do any of that, guys. You just keep investing in the market. I apologize about the lawnmower in the back, guys. Somebody's out here mowing their lawn, and It's a beautiful day. You might as well mow your lawn, right? So guys, hey, keep doing what you're doing. Stay tuned to this channel for more updates on the U.S. economy, and I'm going to try to give it to you in plain language. Listen, if you got anything out of the video, do me a favor, smash the like button, and please consider subscribing if you're not a subscriber. Hey, the best person that's going to take care of the old you is the young you. Guys, take care of yourself and always take care of other people. Until the next video, peace.